Emergency broadcast. Turn off the news. Close the portfolio app. Stop refreshing that price. The report that leaked 41 minutes ago wasn't meant for your eyes. The Swiss institution named inside it has 1 month to choose how it dies, and the number buried in that choice is $298 per ounce, starting January 11th, 2026, starting today. This will be denied within hours. Classified, retracted, called misinformation by morning. But I'm holding 9 pages that prove Switzerland's reputation as the world's safest banking system just became a lie, and the mathematics inside these pages don't negotiate. Let me tell you about a discovery. January 9th, 2026, 1:17 a.m. Zurich time. A systems analyst at UBS runs a routine integration check. 2 years after the Credit Suisse merger, the final databases are being consolidated. He's looking for minor discrepancies, rounding errors, the normal debris of combining two massive institutions. The screen populates, and the number that appears makes no sense. He checks it again. Same result. He escalates to a supervisor. The supervisor calls the risk desk. The risk desk wakes up an executive. By 3 a.m., the entire executive board is staring at a conference room screen showing a position that shouldn't exist. 5.2 billion ounces of silver, sold short. Never disclosed, never reported, never managed. Just sitting in Credit Suisse's shadow systems like a landmine that nobody knew was armed. UBS thought they were managing 1.8 billion ounces combined when they absorbed Credit Suisse in March 2023. The actual number is 5.2 billion. They were off by 290%. For 3 years, Switzerland's largest bank operated with a silver position large enough to bankrupt them, and they didn't know it existed until the database integration completed last week. Here's what 5.2 billion ounces means in real terms. Planet Earth's silver mines produce 800 million ounces annually. 5.2 billion is 6.5 years of total global production. If every mine on Earth stopped selling to anyone else and dedicated 100% of output exclusively to covering UBS's position, it would take over 6 years. UBS has 30 days. But you need to understand how this position came to exist, because this isn't reckless trading. This is something worse. This is institutional amnesia caused by crisis. March 2023, Credit Suisse is dying, liquidity evaporating, clients withdrawing, billions daily, confidence destroyed. The Swiss government watches their second largest bank spiral toward collapse and faces a choice that's not really a choice. Let Credit Suisse fail and watch Switzerland's centuries-old reputation as the world's financial safe haven disintegrate. Or force UBS to absorb Credit Suisse in an emergency merger and pray the combined institution survives. They chose survival. The Swiss National Bank provided emergency liquidity. The government passed emergency legislation. And UBS, given 72 hours to complete due diligence on one of the world's largest banks, did what anyone would do in 72 hours. They checked the highlights, reviewed the major exposures, asked Credit Suisse what their silver position looked like. Credit Suisse said 400 million ounces. Manageable. UBS nodded. They had their own silver short of 1.4 billion ounces, combined position of 1.8 billion. Not comfortable, but survivable. They signed the merger documents. What nobody saw was the London desk. Credit Suisse's metals trading operation had built a separate system between 2015 and 2023, off-balance sheet derivatives structured with non-standard settlement terms that made them invisible to normal accounting. 3.8 billion ounces of naked shorts accumulated over 8 years by traders who believed they were hedged. They weren't. When UBS took over, they dismissed Credit Suisse's management. The people who might have known about the shadow book were gone. The documentation stayed buried in legacy systems that wouldn't integrate with UBS's infrastructure for another 2 years, and UBS operated for nearly 3 years thinking they were managing a large but survivable position. December 2025. The integration completes. A junior analyst sees numbers that don't match. He investigates. The discrepancy grows. He escalates. And by January 9th at 1 a.m., UBS discovers they're sitting on a 5.2 billion ounce short position with mark-to-market losses of 223 billion Swiss francs against Tier 1 capital of 103 billion. In accounting terms, UBS is already insolvent. They're walking dead. They just haven't fallen over yet. 3 hours later, the phone call, Swiss National Bank, emergency meeting, 0300 hours. UBS's executive board presents everything, the position, the losses, how it happened, what happens next. The SNB chairman's written response arrives at 4:30 a.m., one page. Clinical, final. The critical paragraph reads like a sentencing. UBS exists because we provided liquidity when Credit Suisse collapsed. That support is conditional on prudent risk management. A 5.2 billion ounce silver short is not prudent. It threatens the Swiss franc. If UBS fails, confidence in Swiss banking collapses. If confidence collapses, the franc collapses. Switzerland cannot permit this. You have 30 days to reduce exposure by 80%, or we withdraw liquidity support. Without our support, you have 48 hours until insolvency. Choose 30 days. 4.2 billion ounces must close. Deadline February 10th. And simultaneously, the Swiss Federal Council convenes. They've been notified by the SNB. They see the exposure, and they reach their own conclusion. UBS cannot fail, but UBS cannot threaten Swiss stability either. So the Finance Ministry prepares nationalization legislation. If UBS doesn't exit by February 10th, Parliament votes on full government takeover. Estimated cost, 300 billion francs to Swiss taxpayers. Vote scheduled for February 15th. The message is unambiguous. Exit voluntarily or we force you out. Either way, private UBS ends by mid-February. 3 crises simultaneously. The inherited position they didn't know existed. The central bank threatening to pull life support. The government ready to nationalize. Any single crisis would be catastrophic. Together they leave one option. Buy everything at any price for 30 days. And here's why that's impossible. Global silver markets trade 8 million ounces daily across all venues. Physical, futures, forwards, everything. 8 million ounces on normal days. UBS needs to close 4.2 billion in 30 days. Minimum requirement, 140 million ounces daily. But they need front-loaded execution to prove early progress to the SNB. Revised schedule concentrates 70% of buying in the first 20 days. 173 million ounces per day for 20 consecutive days. That's 21.6 times total global daily trading volume every day for 20 days. There's no historical precedent. This isn't a market exit. This is Switzerland detonating its own banking system in controlled fashion because the alternative is uncontrolled detonation. UBS hired 3 independent risk consultants to model available supply over 30 days. Mine production, 66 million ounces. ETF redemptions induced by price increases, 276 million. Private investor liquidation, 216 million. Industrial inventory, 118 million. Sovereign strategic sales, 90 million. Total available from all sources, 766 million ounces. UBS requirement, 4.2 billion. Shortfall, 3.4 billion ounces. Physical supply covers 18% of what's needed. The remaining 82% must close through cash settlements, contract buyouts, and deferred obligations. The physical silver doesn't exist, not at any price. So the strategy becomes hybrid. Stage 1, purchase all available physical up to $350 per ounce, 766 million ounces. Stage 2, close exchange positions by buying offsetting contracts, 1.6 billion ounces. Stage 3, negotiate cash settlements with OTC counterparties instead of physical delivery, 1.2 billion ounces. Stage 4, convert unallocated obligations to long-term minor commitments for future delivery, 650 million ounces deferred to 2027 through 2029. Total projected cost, 952 billion francs. Net after liquidations, 189 billion. And the price modeling? 3 scenarios. Optimistic case with smooth execution, 259 per ounce. Base case with moderate disruption and normal competitive buying, 298. Severe case with cascade covering and aggressive front-running, 437. Risk committee assessment. Scenario 2, most probable, UBS's exit drives silver to $298. That's the equilibrium where enough supply emerges without triggering panic that would force other large shorts to cover simultaneously and push prices to 437. 298 is the mathematical price of Switzerland's survival, but there are no guarantees. If scenario 3 unfolds, losses increase by another 160 billion francs. Context: GameStop, January 2021. Short interest 140% afloat. Shorts needed 1.4 times available shares. Price went from 20 to 500. 2,400% gain in 14 days. UBS is short 6.5 times annual global production. Not 1.4 times, 6.5. UBS's position is 4.6 times worse than GameStop mathematically. If you scale GameStop's dynamics by that ratio, you get over 11,000% gain. Silver from $82 to $9,000. Obviously impossible. But it illustrates the scale of what UBS is attempting. They're trying to cover a position 4 to 5 times more impossible than the most famous short squeeze in modern market history. And they have 30 days. 298 isn't speculation. It's the conservative mathematical estimate of what happens when an immovable shortage meets an unstoppable deadline. And then there's China. Swiss intelligence confirms Chinese state entities know about UBS's forced exit through diplomatic and financial channels. China's estimated allocation for silver purchases in January and February, $28 billion. At current prices, 340 million ounces of buying capacity. But if UBS drives prices higher, China increases dollar allocation to maintain ounce targets. The model assumes China purchases 150 to 250 million ounces during UBS's 30-day window. Chinese strategy: front-run UBS buying. When UBS creates momentum, China buys aggressively to ride it. When UBS pauses, China continues buying to establish new price floors. This ratcheting effect prevents pullbacks and forces UBS to buy at progressively higher prices daily. Maximum Chinese aggression, 300 million ounces or more, could push UBS's terminal price to 340 to 380 instead of 298. China has unlimited capital and no deadline. UBS has 30 days and a central bank execution order. China will outbid them for every ounce. Switzerland cannot stop it. And here's what Section 11 of the Risk Committee report warns about: retail liquidation inducement strategy. UBS's exit plan includes coordinated efforts to encourage retail selling, working with Swiss and international brokers to recommend profit-taking. The messaging: silver has rallied substantially, prudent to protect gains. Markets typically correct after major moves, better to sell now and re-enter lower. This messaging flows through financial advisors, wealth platforms, sponsored media content. The goal: induce voluntary liquidation to create supply for forced purchases. Translation: they're going to try scaring you into selling. Advisors calling with profit recommendations. Articles about overbought conditions. Analyst predictions of corrections. All designed to trick you into giving UBS the silver they need to prevent Swiss banking collapse. Don't do it. UBS needs your silver. You don't need to sell. They're short 5.2 billion ounces with a 30-day deadline, an SNB ultimatum, and nationalization threat. Their risk committee says 298 base case, 437 severe case. Why sell at 90? Why sell at 120? Why sell at 160 when their own analysis says 298 minimum? Hold your silver. Make UBS pay 298. Make them pay 405 for physical if premiums widen as projected. Make them pay 437 if severe case unfolds. They have no choice. They must buy. You don't have to sell. The execution schedule begins today, January 11th through 18th. Aggressive accumulation, 1.4 billion ounces. Heavy exchange buying, physical purchases in London and Zurich. Price projection, 82 to 134, January 19th through 28th. Sustained covering, 1.7 billion ounces, continued futures, OTC settlements, physical buying, price projection, 134 to 217, January 29th through February 7th, final push, 1.1 billion ounces, close remaining positions, finalized settlements, price projection, 217 to 298, February 8th through 10th, verification, confirm 80% reduction, submit to SNB, demonstrate compliance. 30 days, 4 phases, Price increases each phase. By January 18th, 134. By January 28th, 217. By February 7th, 298. UBS buys every single day. 173 million ounces daily for 20 days. The largest sustained commodity buying operation in history. Beginning today. When UBS purchases 173 million ounces today, price doesn't stay at 82. It moves to 89, 96, 103. Tomorrow, another 173 million. Price climbs to 110, 117. Day after day, 30 days. Mathematics, not speculation. Because UBS has no alternative. Because Switzerland chose survival over everything. The fortress that never falls is falling. The safe haven that survived 2 world wars, the Cold War, every financial crisis for centuries, is burning from within. Credit Suisse's time bomb detonated. UBS inherited the explosion. The SNB delivered ultimatum. The government prepared nationalization. $298 is the price of Switzerland's survival. This isn't another bank crisis. This is the death certificate of Switzerland as the world's financial fortress. Written by UBS's Risk Committee, stamped with a 30-day deadline, executed starting today. The math is final. Switzerland is collapsing under the weight of silver it sold but never possessed. The institutions that built reputations on Swiss stability watch the foundation fracture. Hold your silver. Watch the fortress burn. When UBS reaches 298 on February 7th, decide whether you sell or hold for 437. Either way, Switzerland already lost. The safe haven chose itself, and in that choice revealed it was never truly safe. This is the endgame. Not another cycle, not another correction. The endgame. Switzerland surrendered. The war ended. We won.